Hey folks, how are things? Thanks everyone for taking the time and joining us today for a deep dive on contribution margin. So, while it's certainly maybe not winning any competitions for the most exciting topic in the world for most people, for anyone in e-commerce, hopefully at the end of this 30 or so minutes, it'll be an exciting and really beneficial tool that you can use in order to grow with profit in mind, which means more confidence in the decisions you're making and more clarity in your ability to make them. So, just maybe to kick off and give everyone a chance to kind of get settled, to give a quick introduction on myself and Thomas. So, we're both the co-founders of Store Hero, a profit-focused e-commerce analytics platform to help businesses make profit-focused decisions, with revenue as a clear guide and the only guide. Ultimately, we want to kind of show people how that actually might be a limiting factor in your success and growth as a business. That often, and a lot of the kind of platform itself naturally comes from both myself and Thomas's background. I've spent the last 8 years running a digital marketing agency and seeing how data tracking and privacy changes have really made it difficult to know what's working and what isn't. Every platform is giving a slightly different answer. And with that, there's confusion. Not only you're not getting to the point where you're making decisions, you're still stuck on, I suppose, the information that you're trying to take into account to put yourself in a position to make good decisions. So really, that's what kind of led me to Store Hero. Maybe Thomas can give a quick introduction as well.
Hey guys, really appreciate everyone jumping on today. By the way, any questions anyone has, just drop them in the chat there, and we get to them at the end. For those of you who don't know me, Thomas, co-founder here at StoreHero.ai. My own background, I suppose, I grew up with a house at home with e-commerce. My mother's had an e-commerce business while we.ie for almost 20 years at this stage. I've had a couple of different e-commerce brands myself over the years and spent 3.5 years working at Shopify with some of the largest brands, and I suppose consistently ran into the same probably troubles as everyone on this call, really trying to quantify as we spend more marketing spend, is it actually more profitable, or are we just driving more top line revenue for the sake of it, and maybe we're not actually as profitable as a whole? So I think that's really led me to Store Hero over the last couple of years. So really looking forward to kind of getting into the weeds of this and getting in a bit deeper.
Great. I suppose to kind of add to that, maybe just again to give a quick 2-minute introduction on the platform, you've kind of alluded to it there. Really, what we're trying to do is give people a better central hub to make decisions, again, all through the lens of profitability. And we can actually speak to that problem in a little bit more detail. So with Store Hero, you can not only unify all of your sales and marketing data, but critically, you can also unify those costs. So you're making decisions between with all those costs in mind, and naturally these components often can be the difference between success and failure. When you get to the end of the month, speaking to the accountant to understand, was the hard work put in on a daily basis for good reason? Was it purposeful? Did we make decisions for the right reasons, and therefore are we in the position we want to be? So I suppose first and foremost, to kind of set the agenda, a couple of things we want to run through again over the next 25 or so minutes, leaving time for Q&A. As part of the initial sign-up form, you'll notice there was an option there to leave a question in advance. There's a couple of them that came in over the course of the last week or so, so we can start there. But by all means, as we go, feel free to drop anything in the chat. We'll answer it as we go, or alternatively at the end. So we're first of all touching that problem. Ultimately, what is the current landscape today, and what we're doing about it with Store Hero. The shift to profitability reporting and using contribution margin as a solution for some of those problems. How to use contribution margin on an ongoing basis to scale profitably. And we'll run through a couple of real life scenarios. We've been fortunate enough to get some permission from some actual Store Hero users to pull up those dashboards anonymously and give a sense of how this actually works on a daily basis. And then from there as well, we can dive into that Q&A to hopefully give a little bit more of a reference point. So first and foremost, to kind of deal with that problem piece. So this is again the consistent question we get from brands. How can I grow? But not only the sentence and the question doesn't end there, I suppose. Profitably is the key component at the end of that sentence, which isn't as much of a given as it once was. And everyone will know that over the last 5 years, it's been easy. It didn't feel easy at the time, but comparatively, we maybe look back at it a little bit more fondly. It's been easy to start an e-commerce business. Tools like Shopify, Google Ads, Meta Ads have made it very easy to do that. But it's, again, very difficult to do that by remaining profitable. This really, I suppose, epitomizes the decisions and the kind of maybe frame of reference that people have had when it comes to business growth in general. It's not unique to e-commerce, but everyone has had a pivotal realignment towards profitability. That's not to say that there isn't venture-backed startups, there's not venture-backed e-commerce businesses, but nobody has the luxury to forgo a clear understanding of the unit economics. And this is really why. Ultimately, you can see here, this is, the problem lies in the costs that people face on a daily basis. And most stores will use revenue as a daily indicator of success. Now that, ultimately is in an industry, e-commerce, known for its complex cost structure. And I suppose everyday brands are spending billions of dollars with no idea on how profitable that actually is. And I suppose the important point to flag there is, some people are just using revenue metrics, and some people are potentially have a sense of their cost of goods, but for no fault of their own, it's not delivered in a format that allows marketers or business owners to make clear decisions on a daily basis. It's what I found on the digital marketing agency side, and what Thomas found in his family business and working with those companies at Shopify. Ultimately, in the short term, ROAS has traditionally been a metric that has maybe been considered a North Star, especially in the context of business growth. Naturally, that overarching net sales number is going to give you a daily view. But in terms of the levers that you have at your disposal, ROAS is typically the one that you're looking at. Now, there's a couple of reasons why we would see ROAS as an important metric, but not necessarily the full bigger picture. So number one, for context, anyone who's not familiar, ROAS is going to be your return on advertising spend. For every €1, $1, £1 you invest in paid advertising, what does that actually translate to when it comes to revenue and convert the value of the conversions you've generated through your business? A 3x ROAS will mean a 3x return on that ad spend. So ultimately, again, that or is representing return. It's not profit. And really, the first point there is really important to keep in mind. ROAS as a metric doesn't factor in any order-related costs. If we spend €1 to generate €2, that might be good for some businesses, but not as beneficial for others. To that second point there, because and the reason for that is everyone's underlying unit economics and margins are different. Some businesses need a 4x return on their investment to break even if they've tighter margins, because they ultimately have to factor in not only the cost of their ads, but all those various costs, the product, packing, shipping, transaction fees, fulfillment, whatever the case may be. We've also seen brands who have really solid unit economics, really good underlying margins, and can actually afford to scale the business really dramatically with a lower ROAS. And so again, higher ROAS doesn't necessarily lead into the next point. It doesn't always. Not only is it always achievable, but is it not always achievable? But sometimes it's very tough to do based on the business. Again, it'd be one thing if it was a couple of years ago. It was open season, everyone making a lot more discretionary purchases at home. We'd love for that component of things at least to have continued, but that ultimately, sadly, isn't the case. Everyone will know themselves. They'll see screenshots online of these fantastic ROAS numbers that maybe others have generated or maybe purported to generate, and that naturally doesn't often apply in the real world. So building a plan around an unachievable ROAS isn't a recipe for success. Finally, high ROAS can also be a missed opportunity. Just because your ads are really efficient doesn't necessarily mean you're generating the most amount of profit you can as a business. And again, depending on your overarching objectives, that's something really to take a look back on and review. So we're going to touch on that now in a second in a little bit more detail on what that practically means and the benefit of that. Now, what does all this mean for brands and agencies? So with no clear idea on what the true North Star kind of goal is, are you looking to maximize revenue? Are you looking to maximize profitability? Are you looking to maximize a marketing metric, maybe new customer acquisition, inventory? Without an understanding of profit-based metrics, it's very difficult for everyone to be aligned around key targets. Again, the business owners and the financial side of the business is going to set targets that naturally take profitability into account. But if anyone from a marketing perspective doesn't have a framework or a format to take that into account, naturally it's no surprise that maybe it's not going to solve itself. That's a big piece. In the absence of data and clear targets, the logical conclusion for most businesses is to say, oh, well, my ROAS needs to be as high as possible. And I'm sure that can be that's not a very quantifiable metric, as high as possible. And again, what's good is that maybe that doesn't necessarily need to be the way. There's an opportunity where you can grow, generate more profit and maybe your ROAS doesn't need to actually be as high in order to achieve it. And I suppose all that confusion that I touched on across those 2 points leads to that broader challenge whereby there's no shared language between marketing and profitability. Again, how can marketers, business owners, financial teams, agencies be able to kind of work together in unison in order to drive a business forward, achieve an objective, if they don't have a common shared language, if they're operating in silos? Ultimately, going back to kind of the core topic of today, if we know that there's money left over from every order after we factor in all our cost of goods, all those variable costs, but also critically after marketing, everyone is happy. So there's something left over after all those costs. That's a really good sign. And practically, that's what contribution margin is. That we're looking at a clear, and that's what we would position as a really unified, relevant North Star that businesses can use in order to drive the actual operations of the business forward. So from here, just to jump into what this actually means. So again, contribution margin is going to look at that overarching net sales number, but it's also going to minus out any of those cost of goods. So product, packing, shipping, transaction fees, taxes, discounts, and some of them already taken out in the form of net sales, but all those variable costs that you can reasonably attribute on an order level. So that naturally gets you as far as your gross profit. Again, the challenge with gross profit, which takes variable costs into account, is it doesn't include what's potentially one of the most variable costs, which is that advertising spend. And ultimately, oftentimes you might refer to contribution margin as gross profit after marketing spend. And that's really what we're positioning from our side and what we found to work as a North Star. And that's the kind of, I suppose, the flag we're putting in the ground and a sense of a direction we're taking. Just before I hand it over to Thomas, I think ultimately the kind of key piece I would leave everyone with is, if you're trying to improve profitability, you need to, looking at a net profit number, for example, is going to be not as very impactful for your team on an ongoing basis, and even yourself on an ongoing basis, to make decisions. Really, what we would see as contribution margin is that not only a valuable, accurate metric, but it's also a metric and a lever that we can actually control on a daily basis. And again, if you're looking to improve profitability, your goal should really be to maximize contribution margin, we would say. The operational expenses do need to be taken into account. And again, I'll hand it over to Thomas, who can go into more detail on that.
Cool. So yeah, looking at here again, I think you just kind of touched on it there, really, Carl. So, a business's primary objective is to create as much profit after the marketing spend to initially cover those operating expenses, so staff costs, rent costs, software fees, all that kind of thing. For instance, here, like if the business generated 50K in profit after marketing spend, but they have rent, they have staff, they have software fees, agencies to pay for. Maybe they accounted to 50K in the same month. That business actually hasn't made any money. They've just about broken even. So the primary objective for every e-commerce brand is really to maximize that profit after marketing spend. And by solely really focusing on ROAS, it doesn't always give the best indicator to kind of maximize what that number is actually going to be. If you want to just click on to the next slide for me there. Just before we kick off on this question, I suppose I'd love to get an understanding from everyone on the call. If you want to type it into the chat, who tends to set the ROAS targets in your business? Is it you as the business operator? And if it is, just type the word brand. And if you're an agency and you're working with clients, to be interested to understand if you set it as an agency or if the brand sets them, just to kind of get an overview in terms of how people tend to approach the ROAS targets within their own business. Might just leave it for a second there. Don't all answer at once now. Brand. Okay, perfect. Brand. So we have 2 brands so far. Okay. even going off that, it's such an interesting point, and one we typically run into so much. That there's such a push and pull, I suppose, within the industry of who actually ends up setting these targets. It can be quite difficult to understand if you're running an agency. Is the ROAS target given to me by the brand actually the best one to maximize the profit of the business? Or what I often see, and I'm sure you guys all see it as well, is that, it is really hard to set that ROAS target. And maybe, a brand might come to you, maybe you're a business owner yourself, and you set that target. Is that actually within the brand's best interests? And it's really hard for all the kind of reasons we've just touched on there. There is such a complex cost structure in e-commerce. It's really hard to actually understand, is the ROAS target that has been handed down to us the best target to actually really try and maximize the profitability of the business? So just for instance, here, we're going to look at a quick table we've kind of mapped out here. So what we're looking at here is, I suppose, varying degrees of ad spend and the efficiency, obviously, of the ROAS there as well. So we can see here, the first one, we spent 10K, we generated 7.5 ROAS. Yes, that generated 75K in growth in revenue, but the business only has a 60% gross profit margin. So, after we take into account the marketing spend and the cost to fulfill all of those orders, the business has only generated 35K in contribution margin or profit after marketing spend, of which they have to cover all of their operating costs there as well. Now, everyone wants to be as efficient as possible with your marketing budget, but that can come at a cost. And it's kind of a weird one to say. We're all in the business of trying to be as efficient with our ad spend as possible. But there's almost like a balance to be struck, in this case, by being the most efficient that we could be and hitting that highest ROAS figure. We actually haven't maximized the amount of contribution margin or profit after marketing spend that the business could have generated. And that can be a hard one to kind of pull and square with yourself, that, we're going to try and really increase ad spend a hell of a lot more than we had before, and we're going to get a lot less return for it, but it's actually in the best interest of the business. And that's actually a really, really hard one. It's a different way of thinking for a lot of businesses. And again, you're kind of moving away from, I suppose, just channel attributed ROAS, campaign level ROAS, more looking at the business impact of what the marketing spend is doing to the business as a whole. And it just gives you much more confidence and clarity in how to actually scale budgets and know that you're really making the best decisions for you and your business. So if we go down here, we can see, the actual, as we usually spend more on ad spend, the degradation, your efficiency on your ad spend tends to degrade. If you spend 10K, maybe you raise it to 50, the return in the ad spend might dip from 7.5 to 6.5 and so on. But what we can see here is, the point of maximum profitability here was when we got down to a 5 ROAS at 100K. We generated 200K in contribution margin. After that, the next line there, we did spend 125K, but the ROAS dipped to 4.25. And we can see, even though the revenue went up, we spent more, revenue went up. Maybe that's great. It's actually not, because the profit after that spend has gone down, and that's just not in the best interests of the business, assuming all the inventory and cash flow are there to be spent. So it's just a really interesting way to look at it. This is really the North Star metric for every business. It's really trying to maximize contribution margin and not trying to maximize efficiency on your ad campaigns at all time, because again, you could be way less efficient at a much higher spend, in which case you're driving way more volume. Yes, you're a little bit more or less efficient, but maybe that's in the interest of the business to drive a much more kind of profit, I suppose, at the end of the day. Do you want to just jump on to the next one there, Carl? Perfect. So again, benefits of profit-focused reporting. So again, you can get better results with a lower ROAS. Kind of touched on that in the last one. Time is money, as cheesy as it sounds. Quicker to see what's working and what isn't. Again, we're not going to get into attribution here. The contribution margin cannot lie to you. The profit after marketing spend is what it is. We're not really relying on what Google or Meta are saying. Your marketing and agency will understand your business much better. Again, if we're solely looking at ROAS on a business level or even on a campaign level, it's quite siloed. I mean, you're operating on Google, you're operating on Meta. Everybody knows there's a lot of double counting going on there. And even if you are looking at just campaign level, it's difficult to really map that back to the overall strategic direction of the business. What the business owner, or you as the business owner, really wants to understand is, as I've dialed up or down my marketing budget this month, has that yielded more profit for me? If yes, let's keep going. If not, we need to probably pull back and realign things a little bit more. Next point there kind of leads into that. That just makes sure that your brand is growing profitably and sustainably, which it's hard to do if you're just consistently looking at ROAS targets. No need to trust one kind of particular attribution window. Again, to the same point there, Meta and Google, you're going to be, the double counting going on there all of the time, but really looking at just a hard line at this, what is the profit after that marketing spend, kind of cuts out a lot of the noise and really just gets you to the point a lot quicker. And obviously that leads into the last point there of, just gives you a lot more confidence and clarity when you raise your ad budgets. Look, I know like it's terrifying if you're running an SME or any budget for on behalf of a business. It can be terrifying to tell a business, or even if you are a business owner, to really try and dial up that ad spend if you're not razor sharp and razor confident on exactly what you need to quantify success. And again, this just cuts out a lot of the noise. It cuts out a lot of the mishmash that you might get from your current ad platforms, and really just aligns you with the best interest of the business as a whole. So we might just jump onto the next screen here, where we're going to look at it's a very, very quick example before we move into 2 live examples. So when we spend an extra €100, if the gross profit after marketing spend or contribution margin goes up, fantastic. We're generating greater number of profitable orders, keep spending more. If we've spent an extra €100 and maybe sales go up, but actually profit is going down, we know we've probably hit that ceiling. And the funnel, we need to maybe relook at the funnel. Is it an issue with our bounce rates, or maybe our creatives not on target? Is our conversion rate optimization not dialed in? Is our offer, maybe our upsells aren't dialed into the level they need to be? There's a lot of other things we might need to look at, but what we do know is, as we've increased ad spend this month, revenue might have gone up, but we actually are less profitable. So we need to probably pull back, realign, and make sure that we understand what's actually causing that.
Just before we go into the live example, I might just take that question from DP in the thread there. So very good question. So DP has asked, do you have to overspend and see contribution margin dropping in order to find that sweet spot monthly? Very good question. So ultimately, what will typically happen is you can kind of, even the example of the table there, there's a bit of a curve effect there. Oftentimes, as you kind of increase spend in order to figure out where your max point is, it won't be a case that it drops straight away. What will happen is that your contribution just won't rise as quickly. So for example, you may see a situation, and I know a live example Thomas will run through will actually indicate this now in a second. You might see, for example, you've increased your ad spend by 10%. I would probably try to increase it incrementally to the extent that we might say in that scenario, okay, we increase our ad spend 10%, our contribution margin only increases 5%. So that's an indication we're maybe getting close to the top of that curve. And that in most cases that will happen first before initially seeing an increase, then seeing a decrease in contribution margin. And to solve that, I would only increase it incrementally to kind of help not jump past that too quickly, if that makes sense.
Cool, perfect. Okay, so next up we're looking at we're going to go through two really quick kind of live examples here. So I suppose first one we're looking at here, we can see it's January 24. And again, this is a comparison to the previous year. So this is an apparel brand that we've started working with probably in October of last year. And we connected at the end of January, and we kind of had a very, very quick look at, I suppose, January year on year to see what kind of changes in the ad account, what kind of changes in the business had happened. And I suppose the first thing that jumped out to me there, as everyone can see here, is there's a huge increase in gross profit. The business decided to really rethink their pricing strategy, probably much to the behest of the e-commerce manager at the time. They weren't very impressed that they were really trying to, probably squeeze more out of their existing customers than they might have needed to. That being said, they had a premium product, and we're very happy that they're providing a very high level of customer satisfaction. And it's really, really worked for the business. It's massively improved the kind of overall unit economics of the business. But there's a couple of kind of key pieces I want to dig into here. So really, for every e-commerce business, you're trying to gauge, as you dial up or down the ad spend there, as you can see in this case, it's risen by 78%. Honestly, I'm not as concerned about the net sales figure in most cases. Really, what I'm trying to figure out is, after that marketing spend and after all of our cost of goods, as I've dialed up that spend, am I more profitable? And if so, by how much? Because in this case, what we can see here is, the business year on year in January rose spend by 78%, which is a big jump and a big number. But the profit after that marketing spend actually doubled. So they're in this kind of weird phase where, ad spend has risen by 78%, but profit after that ad spend, even taking into account that big increase that they've had, has actually doubled. It's risen at a faster rate. which is incredible. And again, you don't come across many businesses that are in that level. But again, it's really, really interesting because it just really, like, the business went on to, like, I think they basically doubled ad spend again in February, and they saw a contribution margin month on month basically go up by 50%, and they've completely realigned their overall kind of sales goals and profit goals for the years as a result. A couple of interesting things again to look at on this is, like, they raised spend by 78%, and the MER, marketing efficiency ratio, actually dipped by 13. So that kind of sounds mad if you're running a brand out there. We're going to nearly double ad spend at a much less efficiency. But that being said, you can see above there that the profit after the ad spend did rise by double basically year on year, which is phenomenal. Just below the contribution margin there, we can see the cost per acquisition did rise by 43%. But again, the kind of improvement there in the unit economics of the business just meant that the profit after marketing spend is skyrocketed as a result. And we can see the bottom right hand corner there, that price increase manifested in the increase in the average order value. If you want to just jump on to the next one there, Carl, we can look at another apparel brand in the States that we're working with on a year-to-date level. Another really, really exciting brand that we've started working with probably 9 or 10 months ago at this stage. These guys they're scaling rapidly right now. So again, year on year, what we're looking at here is, the increase in marketing spend against the contribution margin levels. So again, huge increase in ad spend year on year, up 375%. Yes, top line sales are up 305%. That's fantastic. But honestly, it's not the metric I'm most concerned about or most fixated on. I'm trying to understand, as they've dialed up that ad spend, how has that profit after the ad spend gone up, or has it gone down? And in this case, they've really started to dial up the ad spend, and the profit after the marketing spend has followed. They've dialed up ad spend by 375%, and they've only seen a dip in that marketing efficiency there of 13%, which is phenomenal. This business, when we took them on board first, we've done nothing other than give the business owner confidence and clarity to actually scale it. Previously, and the guy running the brand runs all his own ads, Google and Meta, and is a seriously dialed in operator. But by overly fixating on ROAS, he was kind of missing the larger business picture in terms of how the increases or decreases in his ad spend budgets were actually relating back to the overarching kind of financial objectives of the business. And in his own words, I think he broke all of his own rules last October. I think he said, and by God, did that work, which was fantastic, and it was great to hear. But it's an interesting one. And I think in the last 18 months, what we've come to see with a lot of brands is, they typically fall into one or two brackets. There's a lot of brands that are potentially overspending on their marketing budgets, and there's a lot of work to be done on those kind of brands. But there's a hell of a lot of brands out there as well that are actually underspending on the business, because they're actually unclear on how the increase or decrease in that ad spend can actually help them grow and grow sustainably. Or probably all goes back to the same point in, like, if it's your own budget and you're in full control of it, it can be really, really scary to try and increase that ad budget by 50, 100%. If you're not really, really sharp on what it actually means for the business. But, having a tool in place that brings in not just all of your sales from your e-commerce platform and all of your shipping costs, your transaction fees, your 3PL costs, also bring in all of your marketing spend from all of the various platforms, and actually give you a real-time view in terms of just trying to understand, going back to the exact same point again. I don't mean to be going on about it all the time, but again, it's the most important metric to be looking at from your business, is that as you dial up and down that marketing spend, is your contribution margin going up, or is it going down? And that should be your primary gauge of success and your primary gauge of decision making in terms of how you dial up or down that marketing spend month on month, year over year.
Great. Well, really appreciate everyone's time. I suppose from our perspective, we're eager to dive into a couple of questions to kind of put this into practice. I know the implication of this is going to be slightly different in different people's businesses, so feel free to drop them in the chat. As I mentioned at the start, we had a couple of submitted questions that came through the initial form. So maybe we can kind of go back and forth, Thomas. So first one, maybe if you want to take, how can I forecast a plan with profit in mind? I know this is a consistent one that naturally it's all well and good to have a report that shows me what happened over a previous time period, but how do I use that to build a plan moving forward? Maybe you can give some context on that. Yeah. Throw the first curveball at me.
Yeah, no problem. So typically when we run into this a lot with brands, typically what you're trying to do is to understand, use last year's seasonal data to basically understand if you did 1 million last year in the last 12 months, and you want to go to 2 million this year, if you have a relatively similar kind of product catalog and marketing campaign not marketing calendar for the next 12 months, you can kind of assume that whatever percentage of net sales you maybe had in January of 24 are probably going to happen in January 25, and kind of extrapolate that throughout the year. But to really understand, I suppose, what you need to spend on marketing to really cover your profit base and everything else, typically it's a really kind of simple one, and happy to kind of help anyone run through a calculator that we've built after the call, is, you know, understanding, okay, what's your net sales target? What is your cost of goods to fulfill all of that net sales target that you've hit? What is the operating expenses that the business needs to cover? And also then almost treating profit as a bill that you need to pay. And whatever is left, that's your marketing budget for the year. And it sounds overly simplistic, but again, happy to run through that with anybody after the webinar. If you want to drop us an email or drop me a DM separately. It's a really simple framework, but we've seen it be extremely effective for an awful lot of brands. Again, net sales minus full cost of goods, minus all of your operating costs to run the business, minus the profit goal that you as the business owner want out of the business at the end of the year. Whatever's left, that is your marketing budget for the year, and that divided by your overall net sales. That's the marketing efficiency. Now, I might have lost a couple of people there, maybe getting too mathsy, but again, more than happy to run through it with anybody in a separate call.
I think to even just add to that as well, I think what often happens, and I found this on the agency side working with brands over the years, that people will have a defined idea that somebody will have come up with internally as to, okay, this is our budget for the following, next year, and that budget needs to achieve X budget needs to achieve Y results. But again, that could be realistic or it could be very unrealistic. By setting all the other parameters, it ultimately the output from that calculation and that growth plan that we would often do with brands, as we're saying, with all the realities of your business in mind, here's what you can afford to spend on marketing, and here's what level of return it needs to generate you in order to actually make this whole system work. And sometimes the conclusion there, as Thomas said, is that we need let's say, for example, okay, in order to achieve my goals, I should spend 100K and I need to achieve a 2.2 MER. So for every €1 I spend on marketing for the business overall, I need to generate €2.2 back in sales. If I've generated a 3 MER over the last 12 months, or maybe the last 6 months, okay, I can be pretty confident to say, well, that's a reasonable goal to have. However, if I do that calculation and I realize that because I have a lot of operational expenses, because my cost of goods aren't as high, I only have 50K to spend, and I have to get a 10x return on my money, just to have a dramatic example, in order for this system to work. It's really a good indication that, okay, something might be broken. Is there an opportunity to say, are we maybe being too ambitious with our profit goals? Should we maybe relook at our cost of goods? Should we relook at our operational expenses? Oftentimes the best brands in the world aren't operationally excellent. They have good underlying margins that allow them not to be perfect. So even before they're off to maybe what's the best analogy? They're off the starting line. Let's say they're starting the race in a better position because they can afford to spend more on marketing before they get into that break-even point or loss-making situation. And again, it's easier said than done. It's, again, easy to post those screenshots of very nice net sales numbers or ROAS numbers, but unless you're taking that into account, you're not going to be in as best a position moving forward.
I might just jump in there again. I was chatting to a guy in Australia about 2 or 3 weeks ago, and they run an agency over there, and they were given ROAS targets again by a brand, and they hit them, and they did everything that was supposed to be, but everything that they were supposed to do, but the brand ended up hemorrhaging a lot of money. And when they kind of dug into why, the gross margin that the business had given the agency was, I think, 60%, called it. I'm not sure what the numbers were, but they hadn't taken into account any discounts, and they were heavy discounters. They hadn't taken into account the shipping, the transaction fees, the fulfillment fees, all the return costs. Just be sure, if you are setting your ROAS targets and you are trying to forecast, that you actually understand the cost of goods that your business operates on. Because Justin, I'm sure you'll probably agree, Carol, in the last 18 months, from seeing hundreds of businesses now use the platform, it's definitely a massive area that brands can get wrong. And it's easy to get wrong because it's so fragmented and it's so complex, and it's just a bit all over the place, to be honest with you, for a lot of brands. It's easy to get it wrong, but getting it wrong can be detrimental to understanding how much you can actually afford to spend on different things. Because, if you make the calculations slightly wrong at the start, and you try to hit your forecasts and your budgets based on wrong numbers, you're not going to get the right results. You're not going to hit the numbers that you want. And even if you do hit the numbers that you think you want, you're going to have a much different result than what you initially set out to, because the initial kind of calculation, or the initial data that you're working from maybe hasn't been as clean as you wanted it initially.
100%. Another question in there. So is MER as personalized to a brand as ROAS, or is there a universal MER target? So just to kind of clarify the difference, what will for everyone on the webinar, MER is going to look at the business as a whole. So in this scenario, we're actually not relying on whatever each individual marketing channel will tell you it deserves credit for. We're saying, okay, we know exactly how much you've spent across each channel, and maybe for any other marketing expenses you want to attribute in that. And what's the total net sales revenue, net sales that you've generated as a business? It's broader at the business level. It's not giving any details on a channel level to say, okay, that sale came from Google or Facebook. But I think that's actually the benefit of the metric. And because it's not trusting what Google or Facebook say, it's accurate. It's working from those defined numbers that can't be skewed through attribution. And I think oftentimes what we would see is on a channel by channel level, some businesses actually have this dialed in based on the purchase behavior, the attribution windows. Maybe attribution issues aren't as much of a factor as maybe it is for others. So it's not, but it really depends. Everyone sees that slightly differently. We would see MER as really beneficial there. And I suppose to answer the next question there, is there a universal MER target? There isn't, ultimately, is the short answer. So it's going to be different for every single brand. Ultimately, depending on your margins, that's really the factor. So again, if you've tighter margins, we do have an MER and a break-even point ROAS calculator on our website. That might be a beneficial tool to kind of understand what kind of level and target you need to set. But as a general principle, the tighter your margins are, the higher your MER will need to be. And oftentimes what we would say as part of the planning stage is it's not as much around setting you might want to set an aggressive MER target, but you're really trying to figure out what's the lowest MER I can get away with before I start losing money. Because again, that's putting yourself in a much better position to win. And oftentimes with ROAS and with kind of paid ads channels, people will often look at and see maybe ROAS or efficiency as the only lever at their disposal. The only way is to improve the quality of their ads, quality of their targeting, whatever the case may be. But actually, if we can restructure things within the business to allow for a lesser ROAS, can you increase the opportunity? Is there an opportunity to increase the AOV? Is your free shipping threshold a very dramatic discount you're not factoring into your calculations? All these components can mean that you need a higher MER to survive, and that's a big factor. Do you have anything to add to that, Thomas?
Yeah, I might just add, we're definitely not trying to come on and just bash ROAS as a metric, because I operated ad accounts for years myself, and it was the primary gauge of success I would have had at the time. It's a great indicator of campaign level success and even channel level success to a certain extent, but it's the wrong metric to quantify the business success of the marketing spend. ROAS is like channel level, campaign level, but MER, contribution margin, is more business level. If you're operating a brand, or if you're operating an agency on behalf of your brands, you're really trying to understand and quantify to the person in charge, how has the extra incremental spend yielded profitability? And if you're solely looking at ROAS as trying to kind of bridge the gap there, you're unfortunately missing a lot of the picture that is easily solvable.
Definitely. And very valid point. Ultimately, if you're making kind of channel level decisions, realistically, you're going to want to look at the metrics for that individual channel. But it's really taking that bird's eye view and understanding, okay, is all the efforts you're doing across those individual channels contributing to the profitability of the business overall? So next question in there. So we have how to use contribution margin to convince a client to increase a budget. So presumably this is coming from an agency perspective. How do we get buy-in? That, and maybe to broaden out the question, how can we get everyone aligned around the objectives? Maybe just to tee it up, and if you want to take this one, Thomas, I would say it all really comes back to being very clear on what the goals are of the business, and using that as the centerpiece. Maybe you can take that.
Yeah, I think slow and steady as well. It's if you're operating this on behalf of a brand, it can be a new way of looking at things. But if you see that they have high MER or high ROAS, or maybe they're not even hitting the profit levels that they want to, have the conversation with them. Can we experiment with increasing the budget by 20% this month? And just showing, has that incrementally increased or decreased that profit after marketing spend? I think that's the best way. It's baby steps, kind of crawl, walk, run type of scenario. You're really just trying to understand, as they've started to increase that spend or decrease it, how has that affected the profitability? I think that's the best way. If you can clearly articulate to a brand owner that, okay, we've increased ad spend this month by 20%, and profit after that marketing spend has gone up by 15%, they should be in a position to give you more ad spend the following month and to continue that trajectory and continue that kind of testing period until there's kind of proper buy-in there to just give you a lot more money to spend ultimately.
100%. Next question in there. So if I'm working on improving my contribution margin, are there any smaller green flags to keep an eye out for? So ultimately, that show me that I'm heading in the right direction. So I think the contribution margin as a general principle is quite reactive. So by nature of the fact, in and of itself, on a daily basis, it will give you a good indication if you're heading in the right direction. You may not see, for example, your contribution margin look very significant, but as long as it's increasing to whatever extent, it doesn't exactly have to be as increasing in line with ad spend. I think that's usually a good indication. I think as well, going back to one of the previous slides here that might give a little bit of context on this, typically, brands would kind of fall into two different categories. So if I jump to this one here, so if it's a case where additional, you're spending more and your contribution margin is going up, that's probably the main lever that you should control. If it's a case where it's not, again, even if it's not proportionate, that's when you want to start to look at the other components of the business. So on that basis, to kind of answer that question, there's a lot of other cues that will really answer the question: are the sales that are being generated in the store better quality sales? So I would look at what's happening with your average order value. Is that going up or down? If that's going up, it's basically giving you, allowing you to spend more to acquire a customer. And what are your new and repeat customer, increases or decreases looking like? Is the additional ad spend and additional work that you're doing going to actually build the pool of potential customers rather than just selling to the same ones? And again, you can kind of go into a couple of different other components in that, but broadly, I'd look back at all the kind of key principles. What's the LTV look like, for example? If we feel like we're overall acquiring more better quality sales, then that's a good indication that the business is going to be better off on the back of it.
Yeah, I'd look at previous period. Like if you were looking at, like, for instance, the 1st to the 14th of May, have a quick look at last month. How is the last, if you've dialed up or down the marketing budget, this month versus last month, how has that impacted profitability? And even just try year over year example as well. Like a lot of businesses, you're incrementally increasing spend year over year. That might be a better indicator. If your product catalog and your marketing calendar look pretty similar, which they will do year over year, how has that impacted, or how has that looked for the business as a whole year over year? Again, we're definitely not in the position of like trying to get everyone to spend more and more money on Meta and Google, but often that is the best way to grow the business and to grow profitably, which might sound like a paradox, but honestly, it's not. In a lot of cases, businesses are massively underinvesting in profitable ad channels that are in front of them. And I can understand why it is terrifying to do that and raise those budgets if you're not razor confident, I suppose, on how to quantify that success.
Cool. We've definitely drank the Kool-Aid, by the way. We're definitely given one side, one opinion, but it's one we feel very strongly about because we've seen the same patterns replicated on so many hundreds of accounts at this point. And understanding the relationship between spend and profitability, as long as it's the right information and it's information that you can trust, it's certainly, there's no benefit in not factoring that into your decision making. Now, the last question I have that had come in before the webinar that might actually speak to this a little bit is, what if you want to acquire new customers? So speaking to those goals, I think this is a really important factor. Sometimes we break up a couple of different goals that people will have. Some people will want to maximize revenue. Maybe it's an early stage business and that's there's some prerogative to do so. You want to maximize profitability. Maybe you want to maximize new customer acquisition, or alternatively, maybe you want to sell through on inventory. You have a large, stock component and stock component to your P&L or your balance sheet more so, and that's something that's affecting the business. Ultimately, if you're looking to acquire new customers, that actually may mean you're not looking for the maximum amount of contribution margin this year. and it's just a case of building a plan with that in mind. One metric that I think is really beneficial to keep that in mind is to try to figure out, are you first order profitable, or do you want to be first order profitable? The new customer contribution margin metric in Store Hero will tell you, for every sale generated from a new customer, what was the profit you made after ad spend. So therefore, if the new customer contribution margin is 0, that would mean the profit after marketing spend, you've ultimately broken even on that first order. If the new customer contribution margin is €10, you've made €10 after ad spend from that new customer. If you want to be first order profitable, keep that over 0. So ultimately on that basis, you're growing new customer acquisition, but only to the extent that you're retaining first order profitability. Example of that might be someone selling sofas or furniture. You can't rely on that customer coming back next month again to buy another sofa. So on that basis, you can't afford to push out the date at which you generate profit from that customer. They need to prove themselves there and then. Alternatively, if you're maybe in beauty or skincare or something like that, a perishable good or a replenished good, if you're kind of building into somebody's routine, you can reasonably expect for that person to maybe come back within the next month or whatever the case may be. Again, you have the data to back that up, and that's maybe one thing to keep an eye on. So I think that looks like it's it from a questions perspective. I suppose really glad and delighted to have everyone join, and I know plenty more will watch some of this content in the replay over the next couple of weeks and months, and I'm sure we're going to break it up into clips, because I think there was a couple of really valuable nuggets there that would be beneficial, especially some of those points that came from the Q&A. So thanks everyone for contributing. If there's any questions, Thomas has just dropped a link in there to our site to book a demo and ultimately use Store Hero to hopefully answer some of these questions. We're biased, but we think it's pretty good. So we'd invite you to take some time to have a look. And yeah, more broadly, thanks for taking the time. Everyone's busy, and hopefully this has been beneficial. So hopefully we'll all speak soon. Thanks.
Cheers.